Hello, my name is Daniel Madmoni Ziegler, and in today's video, I will be talking about Fidelity National Information Services. I will be evaluating the company's past performance and future performance using financial modelings. The company was founded in 1968 in Jacksonville, Florida. It offers multiple financial services listed on the Fortune 500 list, has had approximately 20 mergers and acquisitions, has won countless awards throughout its history. It serves more than 20,000 clients, has moved $9 trillion globally, according to the company's website, and its stock growth is more than 375%, which is pretty impressive. Regarding income statement, balance sheet, and cash flow statement, 2017 and 2018 were characterized by lower revenues compared with the past 10 years sales data. However, net earnings in both 2017 and 2018 is significantly higher than 2019, 1,200 millions and 800 million in 2017, 2018 compared to only roughly 300 million in 2019. Regarding the balance sheet, cash equivalents in 2019 were higher compared to both 2017 and 2018, 1,100 million in 2019, 600 million and 700 million in 2017, 2018. Total assets in 2017, 2018 were approximately 24,000 million. So all of those figures are in millions, whereas in 2019, this figure amounted to 83,000 million. The reason was mostly due to increase in goodwill, intangible assets, and additional paid-in capital. So the company basically acquired more businesses, more companies, and invested in more assets that in the future will generate more profits and revenues. Regarding the cash flow statement, so obviously since net earnings are carried over, 2017 and 2018 had a better start compared to 2019 because in this year, in 2019, net earnings figure was very low, but a significant dollar figure in depreciation and amortization in 2019 resulted in greater cash provided by operating activities in 2019. Depreciation and amortization, it's an account that is added back, so it basically provides more cash on hand. Under investing activities, all accounts, they had pretty much the same figures. The only two things or items that stood out were acquisitions and net proceeds from sale of businesses. So regarding the former, in 2017, 2018, the company had $0 in acquisitions, but in 2019, Fidelity had 6,000 million in acquisitions. Regarding the latter, Fidelity enjoyed almost 1,400 in net proceeds in 2017, and in 2018, 2019, this amount was very low, so it didn't really had an impact. Other financing activities, I believe there is a trend. So almost all items increased in figures. Fidelity definitely borrowed more money from 9,000 million in 2017 to 30,000 million in 2019. This is a pretty substantial increase in borrowings, and it suggests that the company probably improved its operations, probably expanded, acquired more assets and businesses as mentioned earlier. And overall, there was an increase in cash on hand from 2017 throughout 2019, starting with 600 million in 2017 and ending with 3,000 million in 2019. Again, this is an impressive increase. And the assumptions, because of all of this data, were that sales will increase, that the balance sheet accounts will increase as well, and overall total assets, equity, and liabilities will be higher in 2020 throughout 2022. And same is assumed to apply to cash flow. So the company will have more cash on hand. And let's go to the baseline model. Under the baseline model income statement, revenue overall increased, except for a very minus decrease in 2020, which was assumed by the initial analysis. Operating income increased. EBIT is higher in 2020 throughout 2022. Net income is significantly higher in 2020 throughout 2022, from almost 300 million to between 1,600 million and 2,450 million. Under the balance sheet, cash and equivalents are higher in 2020, 2022 by more than 50%. Preferred stock stayed at $0. Common stock stayed constant at $6. Again, all of those figures are in millions. A short-term investment line was created in order to fill in the gap and to make the balance sheet balanced. So this amount was roughly between 37,000 to $39,000. And total assets, liability, and equity is higher in 2020, 2022 by slightly more than 50%. Regarding the statement of cash flows, more cash provided by operating income, especially because deferred income taxes was carried over. So this amount we can see here in 2019 was significantly higher than 2017, 2018 figures, and this is why it resulted in a higher cash provided by operating income. There were more additions to property, equipment, and software. And was because I had to adjust the cash flows. So I assume that the first thing a company will do is to invest more in property, equipment, and software, basically to expand, to um, to to be more productive. Regarding short-term investing, obviously this item had some impact, especially in 2020 figures, because then it somewhat stabilizes in 21 and 22. Basically, in 2020, it resulted in more cash used in investing activities compared to 2019, but both 2021 2022 resulted in less cash used in investing activities. Under financing activities, borrowing continued with the same pattern. So Fidelity borrowed money, but in lower amounts compared to 2017, 2019. Repayment of borrowings was lower in 2020. Again, this is after adjustments. Then in both 21, 2022, which have almost identical figures as 2018, 2019 figures. Overall, more cash was provided by financing activities in 2020 due to increased borrowings, which obviously provided the company with more money compared to 2019. On the other hand, in 2021, 2022, more cash was used compared to 2019. But overall, there is less cash on hand at the end of 2020, but more cash on hand at the end of both 2021, 2022, which is good, and it is in line with the prior assumptions and the past performances in both the income statement and the balance sheet. And the conclusions are that Fidelity, basically the company showed positive signs of improved performances. The company's figures have overall increased, resulting in more revenues, profits, assets, and cash on hand. And this pattern seems to start at least 10 years ago, and it will continue into the future. What I found about this company is that overall it seems very stabilized. So in the past 10 years, sales overall increased. And again, only in 2017, 2018, there was a negative decrease in sale figures. And this is why there are some slight differences in the balance sheet and the income statement, and also obviously in the cash flow statement. But then we can see that in 2019, there was another increase, a huge increase of more than 20% in sales. And apparently, it improved the balance sheet figures and obviously the income statement figures. And in the balance sheet, as we saw in 2017, 2018, total assets, liability, and equity were roughly around 24,000 millions, but in 2019, this amount increased to 83,000 millions, which is a huge increase. And this is why those assumptions were that the company would continue doing better in the future in 2020 throughout 2022. And yes, cash on hand indeed increased from 2019 to 2021 to 2020, I'm sorry, to 2021, 2022. Overall, the company is a good company, is a pretty solvent company. And I believe that all of those assumptions, all of those analysis, and all of those figures that I calculated are in line with the company's current situation, with the company's past 10 years performances. And that's it. This is all I have for today. And I thank you for watching this video, and I hope you enjoyed. Thank you so much. Bye bye.